Hi, this is Michael King. Welcome back. We're looking at different forms of equity, preferred and common shares, and now we're going to focus on what are common shares. In both Cleary and Rakita, this is going to be sections 19.1, 19.2, as well as section 7.4 from Chapter 7 and Appendix 7B from Chapter 7. Common shares may be called common stock, common equity, and sometimes people just call them equity, but you have to ask which type it is. As a common shareholder, you typically have a vote. Your ownership in the firm is proportional to how many shares you own, as are the number of votes. So if there's 100 shares outstanding, you own 5 shares, you have 5% of the votes. Anyone with more than 50% of the votes can make decisions at these AGMs, such as appointing not only the board of directors, who is there to represent you as a common shareholder, but also to hire or fire the CEO and determine their pay. As a common shareholder or common stockholder, you share in all profits, but you also share in all losses after all the expenses and taxes are paid for the firm. There's no requirement for the firm to pay out any excess cash flow. If they do, it's called a dividend, and if not, it is reinvested in the firm which you own, and it's called retained earnings. So just be aware that you have the lowest claim on any of the assets in the event of bankruptcy, which we call the residual claim. And because of this, you have the highest risk, and so over time you would expect the highest return. But you can still lose all of your money if the company goes bankrupt. So let's take a look at TELUS. TELUS shows us here that 77% of their common shares are held by Canadians and 23% are held by foreign investors. That's because TELUS shares are traded both in Canada and the United States. Notice that TELUS does pay a dividend and that they actually pay a dividend once a quarter. And here are the dates, which are called the ex-dividend dates. If you are a holder of record as of March 10th, you will receive the dividend. If you are a holder of record as of March 11th, you will not receive the quarter one dividend. You often see reporting on what the earnings would be, and by earnings I mean net income or profit. So earnings per share is simply net income divided by the number of common shares outstanding, and that would be here $2.90 in 2019. In addition to those earnings, they paid out $2.25 over the course of the year, which is those 4 quarterly payments. And there would be other metrics that you might want to look at, such as what is the price for one common share. At the end of the calendar year, it was $50.28. And given that the dividend was $2.25 divided by that price, the dividend yield is 4.5%. Again, dividend yield is dividends over a 12-month period divided by the share price today. If you were to look at the share price, which was $50.28, and divided by the basic earnings per share, you would find out that the multiple of price to earnings is 17 times, and this is looking at historical earnings over the last 12 months. As you can see here, if you look at each quarter or for the full year, you can see that the share price has bounced around. For the past 12 months in 2019, the low was $44.51, and the high was $51.43, with a close at the end of the year of $50.28. So typically, a common share is one share, one vote, but that is only true when the company has one share, one class of common equity. Many Canadian companies and companies in Europe, as well as other parts of the world, may have 2 or more share classes with different voting rights. And you can think of Canadian Tire, which has, for example, the A shares are the ones that are traded, Shaw Communications, in which case it is the B shares, and Shopify, in which case they don't necessarily tell you which share classes is the ones traded, but as you can guess, it's the ones with fewer votes. Many people know Google, also known as Alphabet, and you may wonder, well, why do companies have these 2 share classes? Well, the answer is that if the founders decide to maintain control of the company and sell common shares that have no votes or fewer votes, they can raise equity without giving up control. And as you can see here, Larry Page and Sergey Brin, the 2 co-founders, have managed by holding the majority of the Class B common shares of Alphabet to maintain over 51% of all votes. This allows them to control the company despite having a minority of the equity invested in the business. Okay, so what about Shopify? Well, if you want to find out what the share classes are, you would have to look into what's called the the proxy circular or the management proxy. As you can see here, the founder, Toby Luca, he controls 35% of all votes, and most of his votes are coming in the form of the Class B multiple voting shares. You can see that the Class B voting shares have more votes than the Class A shares. Okay, and you can see that he owns the majority of those Class B shares along with another corporation called Clister Credit Corporation, which appears to be owned by one of the corporate directors, John Phillips. So the kind of rights that you would have as a common shareholder are the right to vote at the annual general meeting in proportion to the number of shares you have. Of course, remember that if you have multiple votes, then you have a greater say than if you have no votes. One of the things that is voted at the AGM is the election of the board of directors, who are individuals that oversee the CEO and management and are representing the best interests of shareholders. You may be given a preemptive right, which means a right to buy any future shares that are created and sold by the company in order to avoid having your ownership stake diluted. This might be also called a rights issue or a rights offering. And so how this works is that if you own 10% prior to the new issue of shares, you would be offered the right to buy 10% so that you would continue following the new issuance of shares to own 10% of all the shares outstanding. You have the right to a dividend, but it's not a legal obligation for the company to pay a dividend, and many technology companies simply do not pay dividends. And the good news is that a corporation has limited liability, so your liability is your limited liability is restricted to how many shares you actually own. If the company goes bankrupt, you lose your money, but they can't come after your home and your business and your property and your family. How are we going to value a share? Well, there's three major ways. We're going to talk about market multiples today, which is the easiest. Later, we're going to look at a dividend discount model, which is taking the present value of all future dividends, and that's harder. And the third way you should be aware of is what's called a discounted cash flow model. You basically have to forecast the free cash flow of the business and discount those cash flows at the weighted average cost of capital, and then back out how much of that belongs to the common shareholders. And we're not going to be covering that in this course. If you're interested, please take COM445, Corporate Finance and Valuation. So let's look at some market multiples. Well, a multiple is simply one number divided by another. Typically, we would have a market value on the numerator or the top and some sort of metric from the accounting statements on the bottom. So, for example, you might take the price, a market value, and divide it by an accounting value such as earnings per share, which is net income divided by shares outstanding. You may look at book value per share, which is the value of the common equity on the balance sheet divided by the number of common shares outstanding. You may divide it by cash flows or sales. The idea here is that you're trying to standardize how much it costs for the price of one share across different companies where these metrics may appear to be quite different. Okay, so it's like looking at the temperature. We all know that when it's 15 degrees Celsius, what that means. We do not need to be bundling up because it is quite warm. And so if I told you that the PE for a company is 15 times, then you probably mean that that's kind of a good level for a company's price earnings multiple. It's like a warm day. If I told you that it was 35, however, you would say, wow, it's pretty hot outside. Similarly, if I told you that the PE multiple for a company was 35 times earnings, you would say, wow, that's pretty high. It seems to imply that people are paying a lot. They're willing to wait 35 years to get their monies back. At least that's how the multiple could be interpreted. How do you know if 35 or 15 is good or bad? Well, what we're going to do is we're going to look at other firms that are similar and operate in the same industry. We're going to calculate their price earnings multiple. We're going to take the average of those comparable companies and we're going to compare our company to theirs to see if our multiple is good or bad. So 15 degrees, that seems pretty reasonable when you look at what the temperature is in Europe or in the United States, if you're living here in Canada. But 15 degrees is not so warm if you're looking into countries like India in the summer, the Middle East, or maybe even Asia or countries near the equator. So you need to be looking at comparable places and comparable companies when using this multiple. Just remember that the whole idea of relative valuation is you're just saying, look at this relative to that. And if everything is overvalued, then that doesn't mean that your company is still a good buy. It could mean that the whole market is irrational and everything is overvalued. So beauty is in the eye of the beholder. So I downloaded the multiples for Canadian banks as well as a couple of their US comparables. The nice thing about using multiples is that even though Canadian banks report in Canadian dollars and US banks report in US dollars, we're standardizing a Canadian number, the price, by a Canadian metric, such as the earnings or the book value. And so it is neutral to the currency. Likewise, the US numbers are neutral to US dollar. Here you can see that the PE multiples based on the last 12 months for our Royal Bank of Canada was 13.7, TD Bank 11.5, CIBC 13.5. And you can see that the average for all these companies is 20.1, and the median or the middle value is 13.3. So how do we interpret that? Well, there's a problem with those PE multiples. There is a big outlier. Look at Wells Fargo. Their PE multiple is 78.4 times. Clearly, there's something going on, either with the share price or with their earnings. And in this case, what's going on is that their earnings were extremely low, and as a result, their multiple was artificially high. We call this an outlier, and you would want to delete this from your transaction multiples. You want the transaction multiples, both the mean and the median, to be close to each other. Notice that the mean here is 20.1 and the median is 13.3. If you look over one cell, one column to the right, you'll see that the price to book, the mean and the median are both 1.2, and that tells us that there are no big outliers. Okay, so look at RBC's PE multiple of 13.7 relative to the median. It's a little bit higher, but not too bad. And if you look at RBC's price to book at 1.8 and you compare it to the median price to book of 1.2, it does seem to be trading at a premium or at a higher valuation. Okay, that may make it look less attractive. Price to cash flow, however, it seems to be pretty close to the median, and it does seem to deliver, RBC does seem to deliver a higher return on common equity of 14% versus a median of 10.2. So maybe that's what's explaining the higher multiple. Okay, so let's look at this. How do you calculate the price to earnings? Well, it's price per share divided by earnings per share, where earnings per share may be the last 12 months or the next 12 months. By earnings, we mean net income or profit. You look on the company's income statement, you look at what the profit is available to common shareholders, you divide it by the number of shares outstanding. If the price is $50 and the earnings per share was 2, you would say that the price multiple is 25 times. Market to book could be called price to book. Numerator is the capitalization of the stock or the company divided by the value of the common equity. Or if you want to look at it on a per share basis, you could call it the price per share of the company, which is simply the market capitalization divided by the number of shares outstanding. And the common equity divided by the number of shares outstanding becomes book value per share. So you might call it price to book value per share. So if the market cap again is the price per share is $50 and the book value per share is $4.55, you can see this company is trading at an 11 times price to book. Let's take a look at TELUS. This is from Yahoo Finance just the other day, January 22nd. You can see that the share price was at $26.44. You can see that the earnings per share for the trailing 12 months, last 12 months, TTM, was $1. And as a result, the PE ratio was 25.47. Notice that on a forward basis, where the earnings are expected to increase, on the right, it's trading at a forward multiple of price divided by future expected earnings of 21.3. We could also look at its price to sales at 2.26, its price to book of 2.8, and also multiples of what the whole value of the company is, taking into account all the assets, which is called enterprise value. You can relate that to sales or to EBITDA. That's it. Thank you very much for your time today.